Let's talk about Leo. He opens his broker app one evening, and there's an ad for a leverage ETF, promising 3 times the daily return of the S&P 500. He's been investing in a plain index fund for 2 years. This looks like the same thing, just faster. So Leo does the obvious thing. He checks. Over the last 12 months, has this index gone up? Yes. So the leverage version must have gone up roughly 3 times as much. Simple multiplication. Except that's not how these products work. And the gap between what Leo assumed and what actually happened is not a small technicality. It's the entire reason these products exist. It's also the entire reason so many people lose money on them, without ever making a single wrong prediction about the market. One thing before we go further. This is not financial advice. Do your own research before you decide anything. Here's something most videos on this topic skip entirely, because most of them are made for an American audience. If you're investing from inside the European Union, most of the famous leverage ETFs you see are US products, and you can't actually buy them on a normal retail account. There's an EU rule that requires a specific disclosure document in your language before a fund can be sold to a retail investor here. Most US fund managers don't produce one, so your broker simply won't let the order through. Not a warning, not a risk disclaimer to click past. The trade doesn't execute. That means that the products sitting on a European broker's shelf are a different set entirely. They're funds built specifically to be sold here, under European rules. Those are the ones worth understanding, because those are the ones you could actually end up holding. Now, before the math, a quick definition, because this word carries the whole video. Leverage means a small move in the market turns into a bigger move for you, in either direction. Let's say a fund uses 3 times leverage. The market goes up 1%. Your investment goes up 3%. The market goes down 1%. Yours goes down 3% too. Same direction as the market. Every time just amplified. A leverage ETF just packages that amplifier into a normal tradable share. You don't do anything special to get it. It's built into the fund itself. That part is simple. What almost nobody explains is what happens when you hold that amplifier for more than a day. Here's the promise on the label. 3 times the return. What that actually means in the fine print every one of these funds carries is 3 times the daily return. Reset every single day. That one word, daily, is the whole story. It sounds like a technicality, but it isn't. Let's say the market drops 10% one day, then rises 11.1% the next. That number isn't a typo. Recovering from a 10% drop takes a bigger percentage gain, because you're now measuring off a smaller amount than you started with. Do the math on that and you're back exactly where you started. Flat. Nothing gained, nothing lost. Now, put a 3 times leverage fund through the same 2 days. Day 1, it doesn't drop 10%, it drops 30. Day 2, it doesn't rise 11.1, it rises 33.3, 3 times the index's move. But that 33.3% gain is calculated on the smaller number left over from day 1, not on the original amount. Run the actual numbers and the leverage fund is down 6.7%. The underlying market went nowhere. The leverage holder still lost money. That's not bad luck. That's not a market call going wrong. That's what the product is engineered to do. Every time the market moves sideways or chops back and forth, the more volatile the ride, the worse this effect gets, even if the destination is exactly where you started. You don't have to take my word for any of this. It's in the fund's own legal documentation. Every leverage ETF sold in Europe publishes a key information document. In this document, the fund manager tells you exactly what the product is built for. One note before the example: the math you just saw used 3 times leverage, because it's the cleanest way to see the effect. The actual fund we're about to look at uses 2 times leverage. Same mechanism, smaller magnitude. The fund itself would lose less than the 3 times example did, but the daily reset effect is identical. Take an actual European example. A 2 times leveraged S&P 500 fund is available on EU brokers right now, and it publishes exactly this kind of document. It states plainly that the fund delivers 2 times the return on a single day only. Hold it longer and the performance won't line up with a simple multiple of the index anymore. Read that sentence again. The fund manager built this product. They profit when you hold it, and their own legally required disclosure document tells you not to hold it for more than a day. So what does the unleveraged version of the same market actually look like? Next to this, compare a standard S&P 500 UCITS fund with a leveraged version tracking the exact same index. The standard one is the kind of fund this channel talks about every week. The standard fund physically holds the underlying shares. The leverage fund uses a swap agreement with a bank to synthesize the daily return. That adds up counterparty risk on top of the leverage risk. You're depending now on that bank to honor the swap. The standard fund's running cost is a small fraction of the leverage funds. And critically, one of them is built and disclosed as a long-term holding. The other explicitly isn't. Same underlying index, structurally different products. It would be dishonest to present these as pointless. They're not, for the purpose they're built for. You get leverage exposure without opening a margin account or borrowing anything yourself. The leverage is built into the fund, not into your own debt. Your maximum loss is what you put in. Full stop. That's different from an actual margin position, which can lose you more than you started with. And for someone trading a short-term view, watching the position daily, that's a legitimate use case. That mechanism hurts a buy and hold investor, but it's the same mechanism that does exactly what it promises for someone who's out again by tomorrow. The issue was never that the product is broken. It's that most people holding one aren't using it the way it's built to be used. This isn't a European quirk either. On the other side of the Atlantic, regulators reached the identical conclusion years ago. Funds that reset daily are typically unsuitable for anyone holding past a single trading session, especially when markets are choppy. Different regulator, different continent, same math, same warning. So back to Leo and that ad on his broker app. The honest answer isn't never touch these. It's that a leverage ETF is a different category of product, different purpose, different intended holding period. It deserves to be judged on those terms, not as a faster version of the same thing. What you do with that is your own decision. Personally, I don't hold leverage ETFs in my own portfolio. That's a personal choice, not a recommendation. Plenty of experienced traders use them exactly as intended, without issue. This video was here for one reason. If you ever click buy on one of these, you should understand it the same way the fund's own paperwork does. If you want the same discipline applied to checking any ETF before you invest, leverage or not, that's exactly what the free checklist covers. Link is in the description. Money is a tool. If you don't learn to control your finances will control you. See you in the next one.